blockchain is a decentralized distributed digital ledger that is used to record transactions across many computers, which we call nodes, in which the record cannot be altered retroactively without, one, the alteration of all subsequent blocks, and two, the consensus of the network. In other words, it's an immutable ledger, and I believe this is its chief characteristic. Some people have been hung up on how blockchain can fractionalize interests in real estate, and it does do that. But to me, fractionalization isn't anything groundbreaking. Those of us in the real estate world know that we're already able to fractionalize interests in real estate quite easily through ownership by pass-through entities like LLCs and partnerships or REITs, or through ownership by tenancy in common structures. Fractionalization is helpful in some sense. It's a necessary component for blockchain to be successful in real estate, but it's not the characteristic that makes this technology so interesting for real estate transactions, or that would deviate the status quo in the future. Immutability is the characteristic that does that. The reason this is so impactful is because with immutability, we now have a technology that has the potential to replace any third-party intermediary. And there are a lot of third-party intermediaries in real estate transactions. NFTs are digital representations of assets, but if you cut through it all, the term non-fungible token is just a new classification of a type of token. And you'll see that by their very nature, tokens representing real estate are NFTs. NFTs are tokens that are unique and irreplaceable, making it impossible for one non-fungible token to be equal to another. Sound familiar? Real estate is known for that same characteristic. Think about the remedy of specific performance as one example. The remedy of specific performance is very prevalent in the real estate world because all real estate in some way is unique. So, grouping unique assets into this NFT bucket has led to the development of a variety of new blockchain platforms that support NFTs. And so real estate tokenization, in some sense, can ride the success of NFTs as a whole. I think a lot of people are scratching their heads and can't seem to understand the difference between buying a tokenized real estate interest and buying publicly traded REIT shares, or in a fund or real estate interest through a crowdfunding platform. I actually don't think it's fair to compare blockchain real estate platforms with REITs, LPs, or crowdfunding platforms, because it's really an apples to oranges type of comparison. Blockchain is a technology. It's a technology that is it's an advanced type of ledger. Any REIT, real estate fund, real estate crowdfunding platform, or any other real estate company could itself easily adopt and use blockchain technology in its own ownership structure to replace an ownership ledger in its capital stack. Potential drawback has to do with unlocking liquidity in the real estate market. A secondary market on the blockchain would create a much more efficient market for that asset. But in some ways, this is a drawback in real estate. I'll explain. If we can create a secondary market where investors are freely transferring interest and pricing data of those trades is transparent, you've essentially created a way more efficient market for that asset that will be priced in real time based on the most current information available to investors, and likely a more robust set of data points than ever before. Similar to the stock market, where stock prices take into account data and information up to the very moment of making the trade, we could theoretically have this as it relates to a particular real estate asset, thereby unlocking liquidity. However, in some ways, real estate has benefited from being an inefficient market. With the benefit of liquidity and constant pricing, we potentially introduce the drawback of volatility. After all, there is a negative correlation between volatility and liquidity. Lower liquidity usually results in more volatile markets and causes prices to change drastically. Higher liquidity usually creates a less volatile market in which prices don't fluctuate as drastically. Creating and implementing a blockchain registry for land ownership would require a complete overhaul of a local government's land registration system. Before a blockchain system can be implemented, the state or county legislator would need to learn how blockchain technology works and understand how to use it most effectively for their county, as well as assess the risks involved. Also, state and county legislators would have to update local laws to enable and regulate a blockchain land recording system. And lastly, land records currently in physical document form would all need to be digitized. So for many jurisdictions, you can imagine the digitization process would take considerable time. But it may be worth it. After all, blockchain would nearly eliminate fraud in the title recording system because blockchain ledgers are immutable and updated in real time. And so it would be much harder for bad information to interrupt the chain, and any tampering with recorded data is easily detectable. Company Medici Land Governance seems to be really at the forefront of this and leading the way. Medici uses blockchain and other technologies to support land governance, titling, and administration with a secure public record of land ownership. And Medici has been working in partnership with a number of governments to provide blockchain land titling platforms. New technological innovation comes new regulations. The legal and regulatory landscape for blockchain is still very much in flux. Regulators have been slow to lay the foundation for the creation and exchange of digital asset tokens. Many regulators have started to contemplate legislation, but not all have developed a system to accommodate the new technology. But outside of this, investors should continue to remain aware of the many regulatory burdens that are in effect for real estate transactions generally, and understand that the use of blockchain and tokenizing real estate does not nullify any of them. The real estate interest itself has not changed. We only created a digital representation of it in the form of an NFT. But the analysis you would do with respect to the interest and whether it is a security should be the same. The big difference, however, is that through tokenization, it is much easier for retail investors to participate in direct real estate investing and for sponsors to access retail investors. So tokenized real estate could make typical real estate projects more susceptible to securities regulations than prior tokenization. I want to thank everyone for joining us today for this discussion. I also want to thank My Law CLE for having me. I really enjoyed presenting on this topic, and I wish everyone who was able to join us well.